Question 1. What is the primary purpose of underwriting guidelines in the insurance process? A. To ensure that insurance policies are sold only to individuals who have the highest risk. B. To provide standardized procedures for evaluating risks and determining coverage. C. To restrict the types of risks the insurance company is willing to cover. D. To allow insurers to determine the exact premium amount for every policyholder. Answer. B. To provide standardized procedures for evaluating risks and determining coverage. Explanation. Underwriting guidelines are essential for ensuring that the underwriting process is consistent, fair, and efficient. They help insurance companies evaluate risk systematically, ensuring that the correct coverage is offered based on the risk profile of the applicant. These guidelines provide standards for underwriting decisions, helping insurers maintain consistency across different underwriters. They do not specifically restrict or set premiums directly. Instead, they ensure that underwriting decisions are made according to the established criteria that reflect the company's risk appetite. Question 2. Scenario question. Mr. Smith is an insurance underwriter reviewing a potential homeowner's policy. He is considering the applicant, Ms. Kelly, who lives in an area prone to flooding. Her house is not currently in a flood zone according to FEMA maps, but it has experienced minor water damage in the past. What should Mr. Smith do next in assessing this risk? A. Approve the application without any additional conditions as the house is not in a flood zone. B. Deny the application because any past water damage indicates the house will flood again. C. Recommend the addition of flood insurance as a rider to the policy despite the absence of a flood zone designation. D. Offer the policy with standard terms but advise Ms. Kelly of the potential for water damage. Answer. C. Recommend the addition of flood insurance as a rider to the policy despite the absence of a flood zone designation. Explanation. In this scenario, even though Ms. Kelly's house is not in designated flood zone, the presence of prior water damage is significant underwriting consideration. An underwriter like Mr. Smith would take into account the historical risk of water damage and recommend adding flood insurance rider. Flood zones do not always represent the full picture of risk, and the risk of water damage is an important factor to consider when underwriting. This decision aligns with risk management principles, which prioritize protecting both the insurer and the insured from unforeseen losses that could occur despite FEMA zone classifications. Question 3. Which of the following is a key factor that insurers consider when using predictive modeling in underwriting? A. The applicant's age and gender alone. B. The applicant's complete history of claims and their use of social media. C. Data from multiple sources, including past claims, demographic data, and behavior patterns. D. The geographic location of the insurance company's headquarters. Answer. C. Data from multiple sources, including past claims, demographic data, and behavior patterns. Explanation. Predictive modeling in underwriting is a sophisticated tool that analyzes data from multiple sources to forecast future risks and behaviors. Insurers do not rely solely on demographic factors like age and gender, but combine these with historical claims data, patterns of behavior, and sometimes even external data, e.g., economic trends, environmental factors. The goal is to identify trends and assess risks more accurately. Predictive modeling goes beyond basic demographic information and looks at a broader range of variables to make more informed underwriting decisions, thereby improving accuracy in pricing and risk assessment. Question 4. Which of the following best describes the role of reinsurance in the underwriting process? A. Reinsurance transfers the entire risk of underwriting to another company, eliminating the need for internal underwriting. B. Reinsurance allows an insurer to spread risk, ensuring that large losses do not jeopardize the financial stability of the company. C. Reinsurance only applies to life insurance policies and is not relevant for property and casualty policies. D. Reinsurance is used exclusively to lower premiums for customers with changing the risk profile of the insurer. Answer. B. Reinsurance allows an insurer to spread risk, ensuring that large losses do not jeopardize the financial stability of the company. Explanation. Reinsurance is a crucial mechanism that helps insurers manage their risk exposure by transferring a portion of the risk to another insurer. The reinsurer, the primary insurer, can spread the financial impact of large or catastrophic losses. This helps maintain the insurer's financial stability, protects it from having to pay the full amount of significant claim. Reinsurance is not restricted to any one type of insurance, but is applied across various lines of business, including property, casualty, and life insurance. It does not affect the risk profile of the insured, but helps manage the insurer's financial health. Question 5. What is the primary difference between a direct underwriting approach and a manual underwriting approach? A. Direct underwriting uses automated tools and algorithms, while manual underwriting requires a human to review each application. B. Direct underwriting is less expensive than manual underwriting because it involves no human involvement at all. C. Manual underwriting is only used in large commercial accounts, whereas direct underwriting is used for personal insurance. D. Direct underwriting involves a higher level of regular oversight than manual underwriting. Answer A. Direct underwriting uses automated tools and algorithms, while manual underwriting requires a human to review each application. Explanation. The primary difference between direct and manual underwriting is the process of evaluation. Direct underwriting uses technology, such as algorithms and automated decision-making tools, to assess risks and determine coverage. This approach is faster and can handle large volumes of applications. Contrast, manual underwriting involves a human underwriter reviewing each application individually, considering the unique circumstances of the applicant and the risks involved. While direct underwriting can speed up the process, manual underwriting is often used for more complex cases where automated tools cannot fully capture all the nuances. Question 6. Scenario question. Mrs. Johnson is applying for a health insurance policy. The underwriting process reveals that she has a history of hypertension, but it is currently well managed with medication. The insurer is considering offering her a policy with specific exclusions for heart-related conditions. What should the underwriter consider in making this decision? A. Deny the application, as hypertension is always a disqualifying factor for health insurance coverage. B. Approve the policy with the standard terms, as hypertension is not a significant risk factor. C. Offer the policy with exclusions for heart-related conditions, as hypertension is a known risk factor for such conditions. D. Approve the application without exclusions, as hypertension is currently well managed with medication. Answer C. Offer the policy with exclusions for heart-related conditions, as hypertension is a known risk factor for such conditions. Explanation. In underwriting health insurance, the underwriter must consider pre-existing conditions such as hypertension and assess the potential future risk. Even if the condition is currently well managed with medication, hypertension is a known risk factor for heart-related complications. As a result, it would be prudent for the underwriter to include exclusions for heart-related conditions in the policy to manage the potential future risk. This approach allows the insurer to provide coverage while mitigating the financial impact of potential claims related to heart issues, which could be exacerbated by the hypertension. Question 7. What is the primary purpose of documenting underwriting decisions? A. To provide evidence of the specific terms and conditions set for an insurance policy. B. To ensure that underwriting decisions can be audited and reviewed for compliance and consistency. C. To communicate directly with the policyholder about the rationale behind the underwriting decision. D. To guarantee that all claims made in the future will be automatically approved. Answer B. To ensure that underwriting decisions can be audited and reviewed for compliance and consistency. Explanation. Documentation of underwriting decisions is vital for maintaining transparency, consistency, and compliance within the insurance company. Proper documentation ensures that each decision can be reviewed and audited if necessary, allowing for accountability in underwriting practices. This process helps prevent errors or biases and ensures decisions align with established underwriting guidelines. It does not serve to directly communicate the rationale to the policyholder or guarantee future claims approval, as claims decisions are separate from underwriting decisions. Question 8. Which of the following best describes the role of technology in modern insurance underwriting? A. Technology primarily replaces underwriters, with no human involvement in risk assessment. B. Technology assists in automating the underwriting process, making it faster and more accurate. C. Technology is used only for policy administration and has no impact on the underwriting process. D. Technology in underwriting only involves the use of digital signatures to finalize policy agreements. Answer B. Technology assists in automating the underwriting process, making it faster and more accurate. Explanation. In modern insurance underwriting, technology plays a critical role in streamlining the process and improving accuracy. Automation tools, data analytics, and predictive modeling are commonly used to assess risks and determine appropriate coverage. These technologies help underwriters make faster, data-driven decisions by processing large amounts of information more efficiently. While technology enhances underwriting, it does not entirely replace human judgment, especially in complex cases where human expertise is required. Question 9. What factor would most likely lead an underwriter to increase the premium for a property insurance policy? A. The applicant's occupation as a firefighter, which decreases the risk of fire. B. The property being located in an area prone to natural disasters like hurricanes. C. The applicant having no prior insurance claims history. D. The property being new and in excellent condition. Answer: B. The property being located in an area prone to natural disasters like hurricanes. Explanation: the location of the insured property is a significant factor in determining the risk associated with the policy. If the property is in an area prone to natural disasters like hurricanes, the underwriter would likely increase the premium to account for the higher risk of damage or loss. Premiums are based on risk assessment and factors like proximity. Natural disaster zones directly influence the risk level and, consequently, the price of the insurance. Question 10. Which of the following is an example of a moral hazard in insurance underwriting? A. A policyholder buys life insurance with no intention of paying premiums. B. A policyholder increases coverage after suffering damage from a recent loss. C. A policyholder's pre-existing medical condition is disclosed during underwriting. D. Policyholder takes steps to prevent car accident by maintaining their vehicle. Answer: hey, a policyholder buys life insurance with no intention of paying premiums. Explanation: moral hazard refers to a situation where the behavior of the insured party increases the likelihood of a claim or loss because the insured party is shielded from the full consequences of their actions. In this case, buying life insurance with no intention of paying premiums reflects moral hazard, as the policyholder has no real financial stake in maintaining policy and may be attempting to take advantage of the insurance without bearing the responsibility. This is distinct from other behaviors, such as increasing coverage after a loss or maintaining a car, which do not directly relate to taking advantage of insurance coverage. Question 11. Which of the following best describes the function of underwriting in the insurance process? A. Underwriting helps insurers determine the premiums for policies by assessing the risk associated with each individual applicant. B. Underwriting is only concerned with approving or denying claims once a policyholder files a request for payment. C. Underwriting determines the amount of commission agents will earn based on the policy sold. D. Underwriting involves deciding how much coverage should be provided regardless of the applicant's risk level. Answer: underwriting helps insurers determine the premiums for policies by assessing the risk associated with each individual applicant. Explanation: the underwriting process helps the insurer evaluate and determine the level of risk associated with an applicant, and based on this evaluation, the insurer sets the appropriate premium. It plays a key role in ensuring that policies are issued to individuals or entities who align with the insurer's risk appetite. Regulatory standards. This helps to balance risk and profitability for the insurer. The underwriting process is not involved in claims processing or agent commissions. Question 12. When underwriting a property insurance policy, which of the following factors would most likely indicate a higher risk? A. The property has an advanced security system and is located in a safe neighborhood. B. The property is located in an area with frequent flooding and the building is constructed with combustible materials. C. The property is located in an area that is historically free from severe weather conditions and has recently undergone renovations. D. The property has a low construction value and is not located near any known risks such as fire hazards. Answer: B. The property is located in an area with frequent flooding and the building is constructed with combustible materials. Explanation: in property insurance underwriting, factors that increase risk typically involve environmental hazards, such as flooding, and the physical characteristics of the building, such as being made from combustible materials. Flood-prone areas pose a higher risk of property damage, and combustible materials increase the potential loss due to fire. Both factors would prompt the underwriter to adjust the policy or premium accordingly. Question 13. What is the primary purpose of an insurance company's underwriting guidelines? A. To ensure that only high-risk applicants are accepted for insurance policies. B. To standardize the process of assessing risk and determining premiums for all applicants. C. To offer discounts to all applicants who meet certain criteria. D. To allow underwriters to approve policies without reviewing individual risks. Answer: B. To standardize the process of assessing risk and determining premiums for all applicants. Explanation: Underwriting guidelines are used to ensure consistency and fairness in the underwriting process. They help standardize how risks are evaluated and how premiums are determined. These guidelines are based on historical data, actuarial models, and legal requirements, and they ensure that the underwriting process is applied consistently across applicants. They do not provide discounts or bypass the need for reviewing individual risks. Question 14. What is the main purpose of risk management in the underwriting process? A. To eliminate all potential risks associated with underwriting decisions. B. To assess the likelihood of claims and mitigate risk exposure through underwriting decisions. C. To maximize the number of policies issued by the insurer. D. To reduce underwriting standards in order to increase profitability. Answer: B. To assess the likelihood of claims and mitigate risk exposure through underwriting decisions. Explanation: Risk management in underwriting involves identifying and evaluating the risks associated with individual applicants and making decisions to mitigate those risks. By assessing factors such as the applicant's history, environmental risks, and property characteristics, underwriters can make informed decisions about whether to approve policy, premium to charge, and whether to apply exclusions or special terms. Question 15. Scenario question. Mr. Adams applies for a life insurance policy with a history of smoking. He recently quit smoking but is concerned that it may affect his premium. What should the underwriter consider in making their decision? A. Mr. Adams should be charged a higher premium for life insurance because he has a history of smoking regardless of whether he quit. B. The fact that Mr. Adams quit smoking recently should result in a reduced premium as the risk is no longer applicable. C. Mr. Adams should be given a standard premium with no consideration of his past smoking history. D. The underwriter should apply a waiting period before offering the policy. If Mr. Adams remains smoke-free, Answer: A. Mr. Adams should be charged a higher premium for life insurance because he has a history of smoking regardless of whether he quit. Explanation: Even though Mr. Adams has quit smoking, underwriters typically consider the applicant's history of smoking as a risk factor, as smoking increases the risk of certain diseases, e.g. heart disease, lung cancer. The underwriting decision would likely include a higher premium based on the applicant's smoking history. Some insurers may offer lower premiums after a certain period of being smoke-free, but it's generally not automatic, and the premium may still be higher than for non-smokers. Question 16. Which of the following would most likely be considered an adverse selection risk in insurance underwriting? A. An individual with no history of claims applying for a new insurance policy. B. An individual with a history of frequent claims applying for a policy from a new insurer. C. A new applicant with a favorable risk profile and no pre-existing conditions. D. An applicant seeking insurance with an excellent credit score and stable employment history. Answer: B. An individual with a history of frequent claims applying for a policy from a new insurer. Explanation: Adverse selection occurs when higher-risk individuals are more likely to seek insurance or when they provide false or incomplete information to obtain insurance. In this case, an individual with a history of frequent claims is likely to apply for coverage because they expect to file additional claims in the future, which is an exam. Adverse selection. Insurers aim to avoid this by carefully underwriting policies and charging higher premiums for applicants who have a history of frequent claims. Question 17. What role does the underwriting cycle play in insurance? A. It dictates when policies should be written based on market conditions and risk levels. B. It determines the final premium amount for policies once underwriting is complete. C. It sets the pricing models used for premiums during the policy renewal process. D. It describes the process by which underwriting decisions are automatically renewed at fixed intervals. Answer: A. It dictates when policies should be written based on market conditions and risk levels. Explanation: The underwriting cycle refers to the period in which underwriting standards and pricing models may shift depending on external factors such as market conditions, claims experience, and changes in the economy. For example, when underwriting standards tighten during a hard market, premiums may increase and underwriting restrictions may be stringent. Conversely, during a soft market, underwriting may become more lenient with lower premiums. The cycle helps insurers manage risk in relation to broader market forces. Question 18. What is the primary advantage of using data analytics in insurance underwriting? A. Data analytics can completely eliminate the need for human underwriters. B. Data analytics allows insurers to set premiums based solely on external factors like location and weather conditions. C. Data analytics enables insurers to predict risk more accurately and make more informed underwriting decisions. D. Data analytics is primarily used for claims processing, not underwriting. Answer. C. Data analytics enables insurers to predict risk more accurately and make more informed underwriting decisions. Explanation. Data analytics is increasingly being used in insurance underwriting to analyze large datasets and identify patterns or trends that can provide insight into risk. By using data analytics, insurers can make more accurate predictions about the risk associated with a policyholder and adjust accordingly. This approach helps improve the accuracy of underwriting decisions, reduce losses, and better align premiums with actual risk. Question 19. Which of the following is an example of a physical hazard in insurance underwriting? A. A history of fraudulent claims made by the applicant. B. A property located near a high crime area with frequent vandalism. C. A building constructed with outdated materials prone to collapse. D. A history of bad credit affecting the applicant's ability to pay premiums. Answer. C. A building constructed with outdated materials prone to collapse. Explanation. Physical hazards are inherent characteristics of a property that increase the likelihood of a loss occurring, such as a building being constructed with weak or outdated materials. These hazards directly affect the risk of damage to the property. Other options refer to moral or legal hazards, which are associated with the behavior or circumstances of the applicant, not the physical condition of the property itself. Question 20. When considering the risk associated with underwriting health insurance, what is the primary concern regarding pre-existing conditions? A. Pre-existing conditions are always excluded from coverage, regardless of their nature. B. Pre-existing conditions increase the risk of future claims, which may result in higher premiums or exclusions. C. Pre-existing conditions are not considered in underwriting decisions for health insurance. D. Pre-existing conditions automatically disqualify applicants from receiving health insurance coverage. Answer. B. Pre-existing conditions increase the risk of future claims, which may result in higher premiums or exclusions. Explanation. Pre-existing conditions are a key consideration in health insurance underwriting. Since these conditions could lead to higher medical costs in the future, they typically result in higher premiums or exclusions for certain types of coverage. Insurers use this information to assess the likelihood of future claims and appropriate pricing or policy terms. However, not all pre-existing conditions lead to automatic disqualification. Question 21. What is the purpose of applying exclusions in insurance policies during the underwriting process? A. To lower the overall cost of the policy by eliminating unnecessary coverage. B. To provide broader coverage that includes more risks for the insured party. C. To limit the insurer's exposure to specific high-risk events that are outside the insurer's underwriting guidelines. D. To allow the insurer to deny all claims made under the policy. Answer. C. To limit the insurer's exposure to specific high-risk events that are outside the insurer's underwriting guidelines. Explanation. Exclusions are used in underwriting to exclude coverage for certain high-risk events or conditions that fall outside of the insurer's guidelines or risk appetite. This helps the insurer manage potential losses and ensures that the policy remains viable and financially sustainable. By limiting coverage for specific risks, exclusions allow the insurer to better control its exposure to certain types of claims. Question 22. How does an underwriter assess the suitability of an applicant for life insurance? A. By evaluating the applicant's income and ability to pay premiums. B. By reviewing the applicant's personal history, health records, and lifestyle choices such as smoking. C. By considering the applicant's occupation and whether it involves any high-risk activities. D. By considering only the applicant's age and family size. Answer. B. By reviewing the applicant's personal history, health records, and lifestyle choices such as smoking. Explanation. Life insurance underwriting involves thorough evaluation of the applicant's health, personal history, and lifestyle choices to determine the risk of insuring them. This includes reviewing medical records, any history of chronic illnesses, and behaviors such as smoking, which could increase the risk of mortality. The underwriting process ensures the insurer is aware of any potential risks that could affect the applicant's life expectancy. Question 23. What is the most common reason an underwriter would deny a property insurance application? A. The applicant has a history of maintaining multiple insurance policies. B. The applicant lives in a region with frequent tornadoes or wildfires. C. The applicant has previously filed a claim for a minor issue. D. The applicant has a high credit score. Answer B. The applicant lives in a region with frequent tornadoes or wildfires. Explanation. Underwriters assess the risk associated with the location of the property when deciding whether to approve a property insurance application. Living in an area prone to frequent natural disasters such as tornadoes or wildfires significantly increases the likelihood of a claim being filed. As such, insurers may deny the application or charge higher premiums. To account for the increased risk, other factors like a high credit score or filing a minor claim in the past would not typically result in a denial. Question 24. What is the key factor that determines the pricing of an auto insurance policy during underwriting? A. The applicant's credit score. B. The type of vehicle and its safety features. C. The number of claims the applicant has made in the past. D. The applicant's occupation. Answer B. The type of vehicle and its safety features. Explanation. The type of vehicle being insured plays a significant role in determining auto insurance premiums. Vehicles that are more expensive to repair have a higher likelihood of being stolen or lack modern safety features tend to have higher premiums. Additionally, safety features such as airbags and anti-theft devices may reduce premiums by reducing the risk of a claim, while credit score. Claims history can also influence premiums. The vehicle itself is often the primary factor. Question 25. Which of the following is considered a moral hazard in the insurance underwriting process? A. A property is located in a high crime area, increasing the risk of theft. B. An applicant with a history of filing frequent insurance claims seeks coverage. C. A house has a faulty electrical system that increases the risk of fire. D. An applicant has a pre-existing health condition, increasing the likelihood of medical treatment. Answer B. An applicant with a history of filing frequent insurance claims seeks coverage. Explanation. A moral hazard refers to a situation where an individual may take more risks because they are insulated from the consequences, typically due to having insurance coverage. In this case, an applicant with a history of filing frequent claims may continue to engage in risky behavior, knowing that their insurer will cover the costs. This behavior increases insurers' exposure to claims, which is why underwriters closely assess an applicant's claims history during the underwriting process. Question 26. What is a loss ratio in insurance underwriting and why is it important? A. The ratio of the insurance company's administrative costs to premium income. B. The ratio of paid claims to the premiums collected, indicating the profitability of an insurer. C. The ratio of the number of policies issued to the number of claims filed. D. The ratio of the insurer's investment income to total premiums. Answer B. The ratio of paid claims to the premiums collected, indicating the profitability of an insurer. Explanation. The loss ratio is a key performance indicator for insurance companies measuring the ratio of claims paid out to premiums collected. It is important because it helps insurers assess whether they are charging enough premium to cover the costs of claims. A high loss ratio indicates that the insurer is paying out a significant portion of its premium income in claims, which may suggest the need for rate adjustments. A low loss ratio, on the other hand, indicates profitability for the insurer. Question 27. What is the primary purpose of applying a deductible in an insurance policy? A. To lower the insurer's liability by sharing the risk with the policyholder. B. To eliminate the possibility of fraudulent claims. C. To ensure that the insurer is able to cover all claims regardless of the amount. D. To provide the policyholder with a fixed amount of coverage regardless of the claim size. Answer A. To lower the insurer's liability by sharing the risk with the policyholder. Explanation. A deductible is the amount the policyholder must pay out of pocket before the insurer starts covering the remaining costs of a claim. It helps lower the insurer's liability and encourages policyholders to avoid making small claims. By sharing in the cost of claims, policyholders have an incentive to manage minor damages themselves, which reduces the frequency, severity of claims for the insurer. Question 28. What is an example of an insurer using an experience rating as system in underwriting? A. The insurer increases premiums for a group based on the overall claims history of that group. B. The insurer offers lower premiums to individuals with low risk profiles. C. The insurer sets premiums based solely on demographic factors such as age and gender. D. The insurer adjusts premiums after each policy period based on the insured's claims history. Answer D. The insurer adjusts premiums after each policy period based on the insured's claims history. Explanation: experience rating involves adjusting premiums based on the actual claims history of the individual or group. If a policyholder or a group has filed numerous claims, their premiums are likely to increase, while those with fewer or no claims will likely see lower premiums. This system is commonly used in commercial insurance. With workers' compensation, where past claims history is a significant factor in determining future premiums. Question 29. What is an underwriting moral hazard? A. The potential for increased risk due to a policyholder's behavior, knowing they are covered by insurance. B. The risk that an applicant may withhold relevant information to gain coverage. C. The danger of underwriting policy based on inaccurate data. D. The risk of market conditions changing after underwriting decisions are made. Answer A. The potential for increased risk due to a policyholder's behavior, knowing they are covered by insurance. Explanation: moral hazard refers to the tendency of individuals to take on more risk when they are insulated from the consequences due to insurance coverage. For example, a person with insurance coverage might engage in risky behavior like leaving car unlocked because they know the insurance company will cover the costs in case of loss. It increases the insurer's risk and can influence underwriting decisions as insurers aim to minimize this type of exposure. Question 30. What is a claim severity in insurance underwriting? A. The frequency of claims filed by an insured individual. B. The financial cost or extent of a claim filed by the policyholder. C. The total number of claims filed by the insurer over a period of time. D. The length of time it takes to process a claim. Answer B. The financial cost or extent of a claim filed by the policyholder. Explanation: claim severity refers to the financial cost of a claim when it occurs. It is a key factor in underwriting because insurers must evaluate not only how often claims are made, claim frequency, but also the potential financial impact of those claims. High claim severity can indicate higher risk and may influence underwriting decisions, leading to premiums or coverage exclusions.